For next year, are you optimistic about the global economy or pessimistic?
Pessimistic.
Pessimistic.
Now that the inflation is slowing down, when is the Fed Reserve going to lower its interest rates? People are struggling and we need answers. Let us try to understand what the Fed Reserve is doing with the crisis. There's a lot of talk about how high inflation has been in the last 3 years, and how it's affected American families. The Fed Reserve says it needs additional data to ensure that inflation is continuously falling to its objective of 2%. This person, Jerome Powell, who leads the Fed, says they want to be sure before they start cutting interest rates. So why is the Fed Reserve doing this? In the US, the Fed Reserve Board is in charge of determining the target interest rate at which banks borrow and lend money to one another, known as the federal funds rate, which has a broad impact on the economy. While a change in this interest rate typically has a 12-month economic impact, the stock market's reaction is frequently more instantaneous. The Fed Reserve controls the federal funds rate to keep inflation under control. By raising the federal funds rate, the Federal Reserve is seeking to reduce the amount of money available for purchases. This increases the cost of obtaining money. Conversely, when the Fed Reserve lowers the Fed funds rate, the money supply expands. This increases spending by making borrowing cheaper. The central banks of other countries follow similar trends. Every loan carries the risk that the borrower will fail to return it. To compensate lenders for their risk, there must be a reward: interest. When a borrower repays a loan, the lender earns interest, and the interest rate is the percentage of the loan amount that the lender charges to lend money. The presence of interest allows borrowers to spend money right away, rather than waiting to save it before making a purchase. The lower the interest rate, the more likely people are to borrow money for large purchases like homes or cars. When customers pay less interest, they have more money to spend, which can lead to a ripple effect of increased expenditure across the economy. Cheaper interest rates can assist businesses and farmers by encouraging them to undertake large equipment purchases at a cheaper cost of borrowing. This leads to increased output and productivity. Higher interest rates, on the other hand, reduce customers' disposable income and force them to reduce their spending. When higher interest rates combine with tighter lending rules, banks offer fewer loans. This impacts not just consumers, but also businesses and farmers, who reduce spending on new equipment, resulting in lower output or fewer staff. Tighter lending criteria will also cause customers to reduce their spending, which will have an impact on many businesses' bottom lines. Whenever interest rates are rising or falling, you'll commonly hear about the federal funds rate. This is a rate that banks use to lend each other money. It can change daily, and because that rate's movement affects all other loans rates, it is used as an indicator to show whether interest rates are rising or falling. These changes can affect both inflation and recessions. Inflation refers to the rise in the price of goods and services over time. It is the result of a strong and healthy economy. However, if inflation is left unchecked, it can lead to a significant loss of purchasing power. Now, let's look at why interest rates matter. When interest rates rise, mortgages and loans become more expensive, potentially slowing the economy. However, when the economy is performing well, prices tend to rise too quickly. That's when the Fed Reserve raises interest rates to cool things down. In fact, this is what happened recently. Inflation rose dramatically, so the Fed boosted interest rates to bring it back down. However, even though inflation has decreased, it remains rather high. The Fed Reserve wants to see it fall much more before decreasing interest rates. They've stated that they may decrease rates this year, but they are cautious. They do not want to repeat the mistakes they made in the past, just like in the 1970s, when inflation spiraled out of control. So they're being cautious and attentively monitoring the facts before making any major decisions. The Fed Reserve has stated that they want to see more evidence that inflation is gradually declining before decreasing interest rates. So while some people are anticipating interest rate decreases, they may not occur soon. Even if they do lower rates, we will not return to the low rates we enjoyed prior to the pandemic. As a result, it is critical to be patient and not to become overly excited about sudden drops in interest rates. In the years preceding the Great Financial Crisis, economic circumstances in the US and other nations were favorable. Economic growth was strong and consistent, with relatively low rates of inflation, unemployment, and interest. In this context, property values soared. Expectations that property prices would continue to climb prompted households, particularly in the US, to borrow excessively and buy and build homes. A similar anticipation of rising house values prompted property developers and households in European countries, including Iceland, Ireland, Spain, and other Eastern European countries, to overborrow. Many mortgage loans, particularly in the US, were for sums equal to or even greater than the purchase price of a home. A major portion of such hazardous borrowing was done by investors seeking short-term profits by flipping properties and subprime borrowers, who have a higher default risk, primarily because of their income and wealth are relatively low and/or they have previously skipped loan repayments. So, why did banks and other lenders issue such a large number of problematic loans? These were the reasons. Firstly, lenders competed to give larger house loans because they expected to make a lot of money in the expanding economy. Then, lenders did not conduct thorough checks on borrowers' ability to repay the loans because they assumed the good times would continue. They also weren't concerned about losing money because they sold a bundle of loans to investors in packages known as mortgage-backed securities. Also, these MBS packages appear to be safe to investors because they believed that even if some loans were not returned, the majority would be. This attracted large US and foreign banks seeking larger profits. In the run-up to the GFC, banks and other investors in the US and overseas borrowed money more to expand their lending and buy MBS securities. Borrowing money to buy an item known as leverage increases possible earnings while also magnifying potential losses. As a result, when the property prices began to collapse, banks and investors suffered significant losses due to their excessive borrowing. Furthermore, banks and certain investors began borrowing money for extremely short periods of time, even overnight, all to buy assets that could not be sold fast. As a result, they grew increasingly reliant on lenders, including other banks, to extend new loans while repaying existing short-term debts. As a result, MBS prices fell, lowering the overall value of MBS and hence the net worth of MBS investors. As a result, investors who purchased MBS with short-term loans found it much more difficult to roll over their loans, exacerbating MBS selling and price falls. So, how did this spread to other nations? Well, as previously stated, foreign banks were active participants in the US housing market, and that was during the boom. Purchasing MBS with short-term US currency funding, US banks have had a significant presence in other countries. These interconnections allowed issues in the US housing market to bleed over into other countries' banking systems and economies. Banking stress peaked in September 2008, with the fall of the US banking giant Lehman Brothers. This, together with the failure or near failure of a number of other financial organizations around the same time, caused a panic in global financial markets. Investors began withdrawing money from banks and investment funds all throughout the world, since they had no idea who would fall next or how vulnerable each institution was to subprime and other troubled loans. As a result, financial markets became dysfunctional since everyone attempted to sell at the same moment, and many institutions seeking new capital were unable to receive it. As confidence fell, businesses and households became less ready to invest and spend, and as a result, the US and several other economies experienced their biggest recession since the Great Depression. What are your expectations about the interest rate? Let us know in the comments below, and don't forget to like, share, and subscribe to our channel for more.